The degree of concentration risk on household balance sheets right now is unprecedented. We are in a huge price bubble in equities. Bubbles do not correct by going sideways. Only two other times historically has the price bubble been as extreme as it is today, 1929 and 1999. And if we get a negative wealth effect on spending from a bear market in equities, that's going to have major implications for consumer spending more than anything else, bigger than the unemployment rate. A bear market in equities this time around will have a more severe impact on consumer spending than what we even saw in '08 and '09. But the music is going to stop, Jack. At some point, the music is going to stop. Could it, will it be in the next year? I expect it will be.
I am very pleased to be joined by David Rosenberg of Rosenberg Research. Dave, great to see you. How are you doing, and how are you assessing the current state of the U.S. economy?
Well, Jack, thanks for having me back on the call, and I'm doing just fine. Thank you very much. I would say that the state of the U.S. economy is, in one word or less, perplexing. And I say that because I don't think I've ever seen such a wide divergence between what the survey data are telling us and what the GDP data are telling us. And I do have a sense as to why there is that gap. But let's just say that I don't really believe that the US economy is expanding at the 3% annual rate that everybody talks about. Of course, is embedded in the third quarter Atlanta Fed projection and the most recent numbers that we've been seeing out of the government database. Meanwhile, when you're taking a look at most of the survey data from the private sector, it's actually more consistent with an economy expanding at about 1.5% than 3%. And I'm still scratching my head over the fact that so many pundits seem to be lulled into this, I think, rather complacent view of American exceptionalism. The latest Beige Book, for example, that just came out showed that, as was the case with the previous report 6 weeks ago, that three-quarters of the US economy is either in stagnation or contraction mode. And I've poured a lot of money, a lot of capital into doing data science at Rosenberg Research, and we've applied that to the Beige Book. And we're starting to do a lot more in that regard with other reports, company reports, so on and so forth. But, the Beige Book is the most comprehensive, qualitative look at the U.S. economy. The Fed's been publishing it since 1970, and it covers all the regions. And the Fed sends its staff into the field to speak to business contacts across not just all regions, but all industries. And the tone of the Beige Book was the same as it was heading into the 1990, 2001, and 2008 recessions. But of course, nobody believes we're ever going to have a recession again. But the tone in this last one, and not just the last one, Jack, but the last two Beige Books, were actually consistent with an economy either in recession or in a significant growth downturn, not an economy accelerating or reaccelerating to 3%. So there is a very big divergence taking place. And I say to the folks at the Fed, if you're not going to listen to your own Beige Book, why bother producing it to begin with? So that's the wide divide. And I think that what is accounting for that wedge is the government. And that's, if you're going to ask me, where I might have gone wrong on the overall economic call, I didn't anticipate that for the second year in a row, the US government would be running a deficit to GDP ratio in excess of 6%. Tremendous ongoing fiscal support for the economy. And that's what gives you this illusion of strength. It's quite remarkable that France has the same deficit to GDP ratio as the United States. And France right now is in a fiscal crisis. In the United States, it's like government support, just bring more of it on. But I think that's really what the story is, because in the beige book and in these surveys, government officials aren't being polled on what their economic activity is. But that's in the GDP data. Uh, and when you strip out the fiscal stimulus that's ongoing, and you assess the direct and indirect impacts, the multiplier effects, the economy actually, the underlying private sector economy is actually expanding, as I said, closer to 1.5% than 3%. But Uncle Sam's deep pockets are making up for that difference. And that's how you get to this American exceptionalism, 3% type growth universe that we're in right now.
Thank you for that. So the survey data, there's a lot of economic data that's indicating weakness or an economy that's growing at less than 3%, but the GDP data is growing at real GDP at 3%. What is some of that data that indicates the weakness? And is it fair to say that this data, whether you're looking at leading economic indicators or other pieces of data, have been looking weak for, in some cases, 2 years now? So just how is it possible that this data has been so weak for so long and GDP continues to be fine and strong, and the economy has not yet entered a recession?
Because of government spending, and all the other aspects of government support, for example, through subsidies, through student debt cancellation. So that's what's happening in terms of this wide divide. But if you look at the ISM surveys, you look at the confidence surveys, you look at the NFIB small business survey, you're taking a look at all the regional Fed bank surveys on both manufacturing and services. And if you look at all of them and you put them into a model, you don't get anywhere close to 3% growth. So that's the survey data that I'm talking about. And then, of course, we got to tack on the beige book. I would posit that just looking at the high frequency monthly data, you're taking a look, for example, at real uh, capital goods shipments and orders. They're running negative year on year. Um, Housing activity, home sales, negative year on year. Um, Real retail sales are basically running fractionally negative year over year. Uh, Industrial production is basically running flat to slightly negative year on year. So you have a lot of pain in the housing market. That's ongoing. Manufacturing has been in and out of recession, as you said, for the past couple of years. And Commercial construction can't get out of its own way for obvious reasons. You can't rely on the export sector with China in a massive growth downturn that Beijing's policies will do a lot to generate animal spirits and liquidity in the banking system and the stock market. However, it doesn't really address the underlying deflationary pressures and the ongoing property morass. Second largest economy in the world, China has flattened its back. Germany, the third largest economy in the world and the largest economy in the EU, heading back into recession. France is in a fiscal crisis. Japan is basically flat on its back. So we can't really rely on the export sector. It really comes down to the consumer. And I think that one of the things that's been happening that's very interesting, because the consumer is about 70% of GDP. And, people would say, well, but we got employment growth, we have income growth. Well, that all is true. However, the really big driver for the consumer has been the equity wealth effect in terms of driving the personal savings rate down. And although there were the upward revisions to the domestic income numbers that we had last month, the savings rate is still half what it was before COVID reared its ugly head in early 2020. The level has been revised up, but the story is still the same about the savings rate drawdown to support spending. People are quite happy to save only 5 cents of every after tax dollar and spend the other 95 cents. Historically, that doesn't last to perpetuity, but that's what's been happening. And when you see your 401ks and you see your monthly statement from your broker or financial advisor, naturally you feel more inclined to spend out of current income. So that's been another part of the story as well, has been this symbiotic relationship between the financial economy and the real economy. That's added whatever juice we've seen to the consumer sector, which is what's held everything together. And as I said before, we cannot rely on exports given what's happening in the rest of the world. Manufacturing activity is in its own recession. Housing activity is in decline. Commercial construction can't get out of its own way. Consumer spending is what's been left alongside the government. And of course, I think that the equity wealth effect on spending via the transmission mechanism of a lower personal savings rate has played a role as well.
Right, and so the equity wealth effect, stocks go up, people have more wealth, they feel wealthier because they are wealthier, so they spend more money. Uh, let's dig into consumer spending. I know you've said earlier that retail sales have been looking weak. I know there's another measure of consumer spending, PCE, and personal consumption expenditures, and that is, I believe, still growing good. It's above, even in I think real terms, above 2019 levels. And then, the big banks just reported. So, for example, American Express, typically high income customers, they are growing their spending at 6%, whereas some of the credit cards that cater to middle and more lower income folks, they are spending less money, or in some cases, they're even contracting their spending. So, yeah, just tell us about, is it true that consumer spending broadly has been very, very strong? And how sustainable do you think it is if it's only just rich people who are buying more because the stock market's up?
Well, I think that's been a big part of it. You've got this K-shaped economy where people who own equities, and they tend to be more upper middle, higher income individuals, are benefiting from that wealth effect. And then you have a whole whack of people at the lower end who continue to live paycheck by paycheck that are still being punished, even as inflation's come way down. It's the still very punishingly high cost of living that is undermining their ability to spend beyond necessities of life, like food and rent and utility. As I said before, I'm trying to mix and match the data you're talking about out of the GDP numbers with what the base book just said. When you read what the base book just said about retail sales and consumer spending, no way are you getting any view that there is any robustness and buoyancy to the consumer sector. And then you're looking at the government data and you're thinking, well, if things are so hunky dory, I mean, that last retail sales report showed that restaurant eating out was just in boom mode. And yet you got Starbucks telling you that same store sales in the last quarter were down 7% year over year. And things are so weak, they pulled their guidance.
Hmm.
Starbucks, which is the poster child for discretionary consumer spending in the services sector. So it does sort of boggle the mind. Like I said before, there's a wide divergence between, Starbucks would be the ones talking to the Fed staff in the beige book. For some reason, the BLS numbers, maybe we got to take the L out of BLS. I don't know, but it's a very wide divide. I said before that the government sector really has filled that void, but at the same time, even on the consumer side, the reports you're getting from most retailers, uh, in terms of their earnings announcements, not lining up with what the government database is telling us within the GDP numbers and retail sales reports.
Mm. And I guess, where is the strength? If people are not going to Starbucks and their spending at Sparks is down 7%, is it on items that are luxury items, for Ferraris and the like? If where's the money being spent?
If you look at the government data, they're spending money everywhere. It's
Yeah.
just, if you look at the private sector data, you're getting a totally different story. The Starbucks of the world showed strength in the retail sales numbers, except the Starbucks in the real world showed an actual outright contraction. So that's what I'm trying to say is that
Mhm.
you asked me at the beginning, how would I describe the state of the US economy? And I said in one word, which for me is always a challenge: perplexing.
Mhm.
Okay, so if you look at the government data, it's like there's a spending spree on practically everything in the goods area and in the services area. But I know, looking at the real world and what CEOs and CFOs are telling us, that is not happening. And I go to the beige book, which is so rich in qualitative information. This is the Fed staffers going out and talking to people in the retail sector. all you're seeing is consumers stretched. And even at the high end, the operative word frugality is setting in. You're not even getting a sense about the Ferraris being sold or the high end. Even they're starting to cut back on their spending patterns. The base book was replete with that. And that's why I'm not a big believer in the inflation story, because every single region of the country, it showed that consumers are pushing back on prices. And so, how does that translate into a robust consumer spending picture? But hey, that is what the quotes official data are telling us. I've got to say, very suspicious over the veracity of the data, more than I have been in my 40 years in the business.
I guess I was asking where in the private sector is the strength that is revealed from those BLS numbers, and I guess your answer is nowhere. You can't see it.
I would say that in my reading of the anecdotal information, we actually have a broadly based slowing in consumer spending activity, especially in the most cyclical areas of the economy. If you go to the government numbers, there's just this wild party that's going on, and it's very difficult. So it's also not just in terms of the magnitude of the divergence, but also in terms of the breadth.
Yeah.
I gotta say, once again, perplexing. It's very hard to make out. But here's what I'll say. I'll say that the survey data and the beige book don't tend to get revised. But the one thing we know about government data is they frequently get revised. And maybe it'll be future downward revisions to the government data that ends up squaring the circle on this debate.
And so, Dave, let's wind the clock back 2 years, October 2022, the bottom in the stock markets. Everyone is worried about a recession. You were one of many economists and pundits to expect that a recession would uh, come to the United States. I remember Bloomberg headlines saying that there is a 99% chance of a recession. I think it's fair to say from then until now, fewer and fewer people have stuck to their recession call. I think you've had stuck to your recession call longer than a lot of people.
Mm.
Was the recession call wrong? And are you is it your base case that the US will enter a recession over the next 6, 12, 18 months? Or what is your current outlook now?
I think I'm back in reliving 2007. And before that, reliving 2000 into 2001. And before then, reliving 1989, 1990. I think that the recession call was way early. I guess benchmarked against the timing, you could say that it was wrong. Um, but it'd be like saying to me in 2007 that I was wrong. I stuck to the recession call. You'd be asking the same question: where's this recession already? The Fed started raising rates in the summer of 2004. That was first under Greenspan and then under Bernanke. They stopped tightening in the summer of 2006. So 2-year tightening cycle that took the funds rate up to about where it was at the peak of this cycle. And then we're just sitting and waiting, sitting and waiting, sitting and waiting. Nothing's happening. And back in 2007, after waiting so long, remember they first started hiking rates in the summer of 2004, and we're into '06. And everybody back then threw in the towel. The only two people I know on Wall Street that didn't was me and Dick Berner, who at that point was chief economist of Morgan Stanley. So um, sometimes the lags are just a lot longer. It's not unusual to have the lag between the first rate hike and the time of the recession last as long as 30 months, if not longer. And that's where we are right now. And back in that period, as I was waiting and waiting, I didn't throw in the towel. Was it frustrating? Sure. But what was I going to do? Throw in the towel in the recession at the end of 2006 and then reestablish it at the end of 2007, which is when the recession actually began. I stuck with the call. Timing is always very difficult, but I stuck with the big call that no, the business cycle was not repealed. I kept on saying it over and over again. The business cycle has not been repealed. We just went through the mother of all tightening cycles. This tightening cycle was even bigger in terms of the increase in the funds rate. And back then, what got clogged up in terms of why the lags were so much longer is that till the bitter end, households were still tapping the last vestige of the housing bubble. Up until the very end, they were squeezing the juice out of the orange in terms of mortgage equity withdrawal, cash out refinancings until they couldn't do it any longer. And then the policy lags finally kicked in because monetary policy hits the economy with lags, and those lags are typically long and can be really long when you have stuff that's acting as an antidote. Back then, it was the wealth generated in the housing market. We knew that that did not have um, a lot of legs beyond 2007. We know what happened next. What happened this time around was the excess savings file, the $2 trillion that was an Energizer bunny handed out to anybody with a pulse in the winter of 2021. And up until very recently, that was an ongoing source of support for consumer spending. And then on top of that, we've had gargantuan fiscal deficits in support of the economy. I mean, back to back years of 6% plus deficit GDP ratios, nobody seems to be too concerned about it. There's no more Tea Party. There's really no more conservatives left anywhere in Washington on the fiscal side. You know, in the old days, like in the 60s and the 70s and the 80s and into the 90s, the government in a recession would take the deficit to 3% or 4% of GDP to fight the recession. We're over 6% right now, 2 years in a row. So, this ongoing fiscal support provides the illusion of economic prosperity that's coming from Uncle Sam's wallet. And that has basically helped extend the cycle. For how much longer? Well, we'll see. And the longer we continue to get government officials, and now we got an election where between Harris and Trump, it's like watching a head boy and head girl uh, high school vote. You know, I'm pledging my next pledge is going to be every high school in the country will be allowed to have root beer in the water fountain. I mean, think about what's happening. But I wasn't expecting this degree of fiscal largesse. That has helped provide an antidote to what the damage the Fed has done, which we haven't seen the full effects yet. Just as the ability to continue to tap your home as an automatic banking machine in 2007, helped extend that cycle as well. But I say, delayed is not derailed. I do not believe in new eras, and I firmly believe in the business cycle. And I think coming off a pernicious interest rate cycle that inverted the yield curve, and admittedly, it's taking time to play out. But I got news for you. This is not the first time the lags were as long as they are today. Ergo, I'm going to bide my time before pulling the plug on the recession call, if I do that at all.
So you didn't throw in the towel in 2006 and 2007. We had as everyone knows, a huge great financial crisis and a recession. So that just to get the timeline and match on now into 2007, the Federal Reserve did its first interest rate cut, a 50 basis point cut on September 18th, 2007. The Federal Reserve just did its first interest rate cut in this year, 2024, September 18th, a 50 basis point cut. Not
Correct.
ominous at all, of course. And then much later, the NBER, National Bureau of Economic Research, declared that the recession began in December 2007. But it made that declaration much later.
In December of '08.
Yeah, but didn't they declare that the recession officially began in December of '07?
But they made the declaration in December of '08.
Yes. Yeah. Okay. Thank you. That's when they made the direct declaration. But the recession actually started 2 months
Correct.
after the Fed's first rate cut. So
Correct.
do you think is that a similar thing in terms of timing? When do you think the economy will enter a
It's hard.
recession?
It's hard to say, Jack, because the NBER, who are the final arbiters of dating expansions and recessions, they wait for all the revisions. So these guys aren't slow and lazy and dumb. They're just waiting for all the revisions. So yeah, they actually made the declaration, and the recession was already a year old. And I think what caught people by surprise was that they dated the start of the recession to December 2007. Most people thought it started in the summer of '08, in between Fannie and Freddie being forced into conservatorship and the collapse of Lehman, Merrill, and AIG. But you see, it started in December of '07. Everybody thought, well, the ball started getting rolling with the collapse of Bear Stearns in March of '08. But no, it was actually the recession that caused all the financial damage. It wasn't the financial damage that caused the recession. The consensus got the causation backward. But they wait for all the revisions, and you're quite right. Look, the stock market peaked on October 9th of '07, uh, really 2 months before the recession started. And almost immediately after that first Fed rate cut, let me tell you something. On September 18th of 2007, that first 50 basis point cut, the market reaction was the same then as it is now. Bond yields went up and the stock market ripped on this reflation trade. People weren't saying that anymore as we moved into the opening months of 2008. But let me tell you that in that first cut in September of '07, that was the market mantra. Stocks ripped. They didn't peak till October, and bond yields went up for the same reason they're going up now. The Fed made a colossal mistake, and then look what happened next. Uh, Interesting enough, go back to 1990. When did the stock market peak? July 90. When did the recession start? July 90. So much for the stock market as a leading indicator. It's really just an indicator of really human emotion and greed and fear. Right now, it's greed on steroids. But it's not really. People say to me all the time, the stock market's telling you there's no recession. Well, let's see what it's saying. Let's see what the stock market is 2 or 3 months from now. Because you could have said that nobody thought the stock market was going to peak in October of '07. When the Fed cut rates in September of '07, the view was that the Fed has taken a down payment against the recession, an insurance policy against the recession. And nobody at the time knew. Well, nobody ever rings the alarm bell at the lows or the highs, anyways. But you couldn't have sold the story that the market was going to peak on October 9th of '07. And for all we know, the market's in the process of peaking at this very moment. And just as I said that it was the housing market that went down uh, after going up and causing all that jubilant consumer spending heading into the peak of the business cycle back in 2007, well, this time around, there's been a lot of equity wealth that's been built up. And nothing lasts forever, right? As Herb Stein, Richard Nixon's chief economist way back when in the '70s, famously said, anything that can't last forever by definition won't. Okay. And the housing bubble did not last forever. And we saw what happened next. And I think the equity bubble, and I am calling it a price bubble, and it'll be interesting to see if the stock market begins to unwind all the excesses and then what the impact is going to be on the savings rate. Because I got news for you. If the savings rate were to ever mean revert, and the savings rate, you talk to people who aren't economists about the savings rate, their eyes glaze over. But I would argue that it is the most important behavioral aggregate in the national accounts. And if the savings rate were to ever, God forbid, mean revert back to where it was pre-COVID, we would have a huge consumer recession on our hands. We would need to have gargantuan employment and organic income growth to prevent that from happening. A mean reversion of the savings rate. And that's one of my principal themes. And it comes down to two very important refrains. One from Herb Stein, as I said before, things that can't last forever by definition won't. And then Bob Farrell's market rule number one, that markets and ratios tend to return to the mean over time. And the savings rate is a ratio, and it is mean reverting. And these are the things people aren't talking about. I think the stock market right now is on wheels, and I don't see it as being any more sustainable than the housing market was on wheels back in 2006, 2007. This too shall come to an end. And as the movie rewinds, the impact on consumer spending is going to be very significant, because I'll tell you why. Over 70% of the household financial asset mix is in equities. And even amongst baby boomers, over the age of 65, 60% of their asset mix is in equities when it really should be closer to 30, 40%. Everybody is all in all at the same time. We've never seen this degree of concentration. Nobody has taken profits. Nobody has de risked. Nobody has diversified. 8% of the household financial asset mix is in bonds, but of course, bonds are for losers. You're not going to get rich buying bonds, but they are a ballast in the portfolio and they're a diversifier, but nobody cares. So the degree of concentration risk on household balance sheets right now is unprecedented. And if we get a negative wealth effect on spending from a bear market in equities, but you see, nobody believes that's ever going to happen, which also is very dangerous groupthink. That's going to have major implications for consumer spending, more than anything else, bigger than the unemployment rate, bigger than fiscal policy. A bear market in equities this time around will have a more severe impact on consumer spending than what we even saw in '08 and '09. So when you're asking me about what keeps me up at night, it is not just about a bear market in equities, which I know is going to happen because markets move in cycles, but the effect this is going to have on confidence and spending, considering the incredible concentration of risk on household balance sheets, that has me very concerned about what that will do for the economy over the next year. And it's out there. Timing it is next to impossible. You know, people accuse me of being stubborn. I'm not parting with my bond call either. I'm still bullish on bonds, and I'll tell you why. When you're taking a look at this stock market, whether you're looking at price to sales, price to EBITDA, price to book, the CAPE, the Buffett indicator, you're talking about 2 to 2.5 standard deviation events. I mean, we've taken the price earnings multiple on a forward basis from 17 to 22 in the past year. Jack, that is a 5-point multiple expansion. It's happened 2% of the time in the past century. That is a 2SD event. And you will never find me ever advocating, ever investing into a 2 standard deviation event unless it's 2 SDs related to a depressed asset class. Like where the S&P was in March of '09 when the banks were priced for zero, or where the market was trading in August of 1982 when the multiple was 8. So there's a lot riding on this call, but the one thing I know is that there's been in the past century only 2 other price bubbles. I'm not talking about that these companies aren't great. The Nvidia's great. You know, the Amazons are great. All these companies are great. They call, you know, the bulls will say, well, you can't compare this to the dot-com bubble, but it wasn't a dot-com bubble. This wasn't about pets.com back in the late 1990s. Technology was in a bubble. And these are great companies that are still around today. Microsoft, Cisco, Dell, Intel. And they went down for about 10 years. They collapsed. Those companies are still around. So your great company, great business model doesn't make it a great stock. It wasn't a dot-com bubble. It was a generalized technology bubble. Only 2 other times historically has the price bubble been as extreme as it is today, 1929 and 1999. And both times, as the bubble corrected, the 10-year yields went down 300 basis points. So I live in a world where assumptions drive your conclusions. I've got an assumption, unlike almost everybody else, I have an assumption that we are in a huge price bubble in equities. Bubbles do not correct by going sideways. And as the movie runs backward, there will be a fund flow, especially because the household sector is so grotesquely underweight bonds. 8% of the portfolio is in bonds, over 70% is in equities, and then the rest is in cash. So yeah, so I'm sticking with the bond call because I could see this happening in, will it be in the next year? I expect it will be. I can't pinpoint the day or month because nobody's that good. But just remember what was it Chuck Prince from Citi famously said in the summer of '07. We're talking about '07. You got to keep dancing till the music stops. And I guess he didn't know at the time the music was going to stop 3 months later. But the music is going to stop, Jack. At some point, the music is going to stop. You know why? Because it always does. but there's more at stake this time around because of the impact that this bull market has had on confidence and spending. And history has shown that it will reverse course in due time.
Hey everyone, we'll get back to the interview in a second, but I do have a huge announcement about the future of the Monetary Matters podcast network. Starting in the fall of 2024, my podcast Monetary Matters will be joined by an entirely new show called Other People's Money. OPM is focused on the business side of the fund management industry. It's not like those other macro shows where people speculate where markets are headed. No, Other People's Money is different. It's an exploration of what it really takes to start, grow, and manage a successful hedge fund. It will feature sincere conversations with real investors with real funds who manage other people's money. The host of Other People's Money is my friend and business partner, Max Weethy. Max and I first met at Real Vision, where, like me, he interviewed many investors and financial thinkers. After 2 years working at a hedge fund, Max is now back in the game, and he'll be sitting in the interviewer chair once again to speak to hedge fund founders and owners for frank discussions about the realities of running money. While Max and I are not fiduciaries, we take the business of other people's money very seriously. We want to give you, the audience, a deep and powerful understanding of how the global financial machine really works, and Other People's Money will further that mission by giving you access to insight from actual fund managers that is normally only available to veterans of the hedge fund industry. Other People's Money will air on the Monetary Matters YouTube channel, and for the first few weeks, it will also air on the Monetary Matters Apple and Spotify podcast feed before transferring to its own feed on all the podcast apps. To help get the show off the ground, it would mean the world to us if you could like, share, and review Other People's Money. Thanks for supporting the Monetary Matters podcast network, and stay tuned for the first episode of Other People's Money with hedge fund manager and activist short seller Carsten Block. Now let's get back to the interview. So I definitely do not dispute that this stock market is expensive right now on a historical basis. With you look at trailing 12-month earnings, next 12-month earnings, EBITDA you mentioned. How would you assess the earnings growth rate of the S&P 500s? So, for example, a price to earnings ratio of 10 is not cheap if earnings are contracting. A earnings ratio of 30 is not expensive if earnings are doubling every year. If it was the S&P 1 and it was just Nvidia, what is the appropriate price to earnings multiple for
Doubling it,
a
yeah.
company that's tripling its earnings?
That's bull market talk, doubling every year. We did
Yeah.
analysis on this. Okay, look, the stock market is a long duration asset. So we went back a century to estimate what is historically, just looking at the norm, because the norm is what's normal by definition. What is the norm for the 5-year compounded annualized growth in earnings per share embedded in valuations at any given moment in time, on average, going back a century? The 5-year expectation, 8% per year. Where are we today, Jack? 17%. More than double. More than double. The last time we had the 5-year embedded growth rate that high was, guess when? In the late 90s. And no, we're not going to have nominal GDP growth that strong unless you think margins are going to go to the moon. We're not going to get 70% per annum EPS growth over the next 5 years. But you see, that's what the market is telling you it expects. And that's why I think that we are in a huge bubble. And every day I get up, I write my daily note every single morning. I get up at 4:20 a.m. because that's how I'm wired. I've been doing that since 1998. First thing I do, I look at my Bloomberg terminal, and every day the equity futures are up. And it's been a great ride. There's no doubt about it. I feel like I'm the kid going to the circus every day and just watching the same clown blow the balloon. And the balloon is getting bigger and bigger and bigger. If you're going to tell me, Jack, you're going to show me your models and say, guess what, Dave, the next 5 years, we're in such a new era and a new paradigm that we are going to generate 17% earnings growth per year for the next 5 years, I'll tell you right away, yeah, okay, well, the market's priced for that, so good on you. By the market, it's fairly valued. But that would be very abnormal, very abnormal. We would have to have like the earnings going on steroids for that to happen. As it stands right now, where's third quarter growth year over year, Jack? Where's third quarter growth? It's running, whether you look at FactSet or Bloomberg, it's running 5-6%. So there's your year over year bird in the hand. Forget the consensus for next year. The bird in the hand, year over year earnings growth is running 5-6%. Okay. And the market's up 35% in the past year. The prices have gone up basically 6 or 7-fold relative to earnings. That's how you get a 5 multiple expansion. Does that make sense to you? But of course, you'll come and you'll say, well, but the market isn't looking at the year over year trailing. They're looking at the next 5 years. And I'm saying exactly. The market's pricing in an earnings trend that is more than double what we've seen historically over the past century. So I guess I'm just a little skeptical that we're going to grow earnings for a 5-year period more than double the historical norm. You got a slight deviation on that, Jack, it's not going to be a pretty picture for where the market's going to go.
Right. I know a lot of the big cap companies that dominate the index, you talked about concentration, their profits were way down in 2022 because their costs were way up. So in 2023, they achieved very high levels of profit growth, but they did so by not because their revenues went up, but because they really cut down their costs. Tesla, for example, just reported what is being viewed as a very solid quarter. Their earnings were up massively year over year, but their revenues were only up 2%. So I would say that can't last forever. You can't always be cutting, for the next 5 years, you're
Right.
constantly just cutting while your revenues stay flat.
Well, plus it's a zero-sum game because you're cutting costs. How are you cutting costs? You're cutting back on suppliers. You're cutting back on wages. Somebody says to me, hey, Rosenberg, I've got to cut my subscriptions in half to save costs. Well, then that comes out of my bottom line. It's a zero-sum game, right? Because your costs are somebody else's revenues.
So I understand your argument. The S&P is very expensive relative to cash, relative to the Treasury 10-year, the 30-year. But is it expensive relative to credit? Because I'm looking at like the high yield spreads, and they are remarkably narrow, probably
Yeah.
above their 90th percentile level of being cheap. So if you are in the world of allocating whether to equities or to high yield bonds, I mean, equities are expensive, but so is high yield.
Yeah. Spreads are stupid tight. I don't want to own the spread, but I don't mind owning the yield. I don't mind owning the yield and IG or high yield, but the spreads are stupid tight. I would still say that the equity market is more expensive than the credit market, and it's a different decision because you don't have to really go through an earnings recession to get the stock market down. You just have to have the market start to mean revert the equity risk premium, which right now is roughly 40-45 basis points. The historical norm is closer to 300 basis points. So you don't need to have a nefarious view or an insidious view of earnings. It's just that the multiple is just stupid, crazy high. And
Mhm.
whatever would cause, and of course, it's just a barometer of confidence and exuberance and excitement. Whatever could cause that to mean revert, well, that would generate the conditions for a bear market just on its own without earnings having to go down. It's a different decision in the credit markets because you're really just concerned about default rates and recovery rates. So long as company balance sheets are in good shape and they can meet their debt servicing obligations, then at least you'll pick up your coupon in the credit market. So I would say that if things unfold the way that I think that they will, I think there will be spreads will widen out. So I don't like the spreads. And you'll still pick up your yield. I think spreads will widen by virtue more of government bonds rallying, causing that spread widening. But I think the stock market's going to be a tougher place to be than credit. Not that I'm bullish on either one of them, because I really just want to dial down the risk in general. Although you could argue that treasuries have duration risk and have inflation risk, so on and so forth. I like the payment guarantee characteristics and the fact that you can pick up a decent yield now compared to what you could have a few years ago. And again, like gold, treasuries offer a ballast and diversifier in the portfolio, and they tend to at least hang in and mitigate the losses in equities when we ultimately go into a recession, which is going to happen, notwithstanding the fact that it hasn't happened yet. The business cycle has not been repealed. That's wash, rinse, repeat. The business cycle has not been repealed. So we get a recession, spreads will widen out. If you're a spread investor, it won't be so pretty. But in high quality companies, you can pick up a decent yield. It's not as safe as Uncle Sam with its taxing powers, but I do like credit generally speaking over equities, notwithstanding.
Dave, one thing you've been right about is that inflation would fall. It peaked at nearly 9% in 2022, and it is now below 3%, much, much closer to the Federal Reserve's target, although not at officially the Federal Reserve's target. Is that one argument that could explain that the rally in all asset prices is just if you adjust by inflation, real spending and real corporate profits are probably up way more because yes, nominal the rate of growth of nominal has gone down, but if you adjust it by inflation, it's exploded in real terms. Could that be one argument why equities have done so well?
Well, look, you mentioned 2022, which was a rough year, for well, both the bond and the stock market. And yeah, when you have 9% inflation, you know, things in real terms end up contracting. And we had, I think, at least one quarter of negative real GDP that particular year. So your point is well taken. Inflation is down to 2.4%. And so if nominal earnings are running 5, 6, then you'd say, yeah, so basically roughly 3% real growth in profits, which I admit that sounds okay. But look what you're paying for that. You're paying a 22 multiple for an inflation adjusted earning stream of 3%. Does not sound like a compelling argument for me to be adding more risk onto the portfolio right now.
And do you expect inflation to continue to fall? And also, will that disinflation, if you do think that, be accompanied by serious declines in nominal activity, the unemployment rate going up, and spending? I think so far the disinflation has been remarkable, given that the unemployment rate hasn't gone up by that much, and the growth hasn't gone by down that much. It's a recessionless disinflation has been good, but it sounds like you don't think that will continue.
Well, I mean, the unemployment rate is still up 7/10 of a percentage point from the lows. So, notwithstanding the past couple of months, the savings rate is on an upward, the unemployment rate is on an upward trajectory. And I think it's absolutely remarkable that if you believe the government's numbers, we have a 3% growth economy in real terms, and yet inflation's coming down, which maybe is telling you something about the supply side, labor force expansion, and productivity growth. I mean, the only way you're going to get inflation from 9 to 3 without a recession, and actually with an economy allegedly growing 3%, is if the supply side is growing even more rapidly than the demand side is. Yeah, I expect that inflation is going to continue to come down irregularly. It won't be a straight line. There's some things in there that tend to be frustrating if you're a bond bull or you're an inflation dove, and we know what auto insurance premiums have been doing, and home insurance and the like. The insurance premium has been a story this year, but I think that the most dominating factor behind, especially the CPI, to a lesser extent the PC deflator, is the shelter components, rent and owner's equivalent rent, which is a third of the CPI. We're starting to see a break in that series finally. There was more evidence of this, by the way, in the recent Beige Book, but you're seeing in real time residential rents are going down. It just takes time before that features into the CPI data because the new rents in the CPI is just a fraction of the overall universe of people that signed on to sky high leases a couple of years ago, but now they're falling out of the data. Don't mean to sound overly technical here, but I think people will be surprised at how the rent numbers are going to play a very significant role in the disinflation momentum over the course of the next 12 months. And I think that what's really caused this shift back down in the inflation rate over the course of the past couple of years has been this shift in the supply and demand curves, a more benevolent shift where supply is outpacing demand. I expect that that's going to be continuing. So I think the overall pressures on inflation for the next year and probably the next 2 years are going to be more down than they're going to be up. Not that there's not other risks out there, especially from government policy, depending on who wins the election. But I think that the fundamental trend that's already been established on inflation, and that the people advocating transitory ended up being proven right, by the way, that fundamental downtrend is going to be intact for the next 12 to 24 months.
Do you think inflation is headed below 2% or below 1.5%?
Jack, we're 2.4, like we're almost there.
Okay.
Yeah. So when I say that the trend is fundamentally down, I'm not saying we're going from 2.4 to 2 and we're going to stay there. I think inflation, I think that in the next 12 months, we could be seeing inflation down towards 0%.
And that would be a very good environment for the 10-year note. Yields would decline,
Right.
probably. The price would rise. What about the shorter end of the curve? The 2-year note is now at 4% yield, or 4 and a few basis points
Yeah.
yield, and that's, I think, pricing in around 5 to 6 cuts over the next, from now until December 2025, and maybe a few more later over the course of the next 2 years. Do you think so? You definitely think that the 10-year will uh, rally, and that that basically that will price in more Fed cuts. Do you think that the short end will rally as well?
Of course. I think the whole curve will rally. The front end will rally the most, and the curve will steepen. And that's the norm in a Fed easing cycle, which just got started. I'm not saying the whole tightening cycle gets reversed, but I think we're going back to where we were pre-COVID, which was a buck 75 on the funds rate. So call that a low of, call it, 2.25 on the 2-year note, and below 3 on the 10-year note. So I don't make a habit of taking the most recent events and then basically extrapolating that into the future. I think that's a big mistake. What you see isn't always what you get. This is the same market reaction we had coming off that first jumbo cut the Fed engineered, as you correctly said, on September 18th of 2007. Um, I think that the economy is going to weaken precipitously. I'm very comfortable with the view that the supply side of the economy will continue to dominate the demand side of the economy, and that will put ongoing downward pressure on the inflation rate. And I think that the Fed will move the funds rate below whatever estimate there is of neutral, which is inherently unobservable. But everything I'm seeing on the economy, from growth to the unemployment rate to the capacity utilization rate to the employment to population ratio, also looking at job opening rates and hiring rates, um, quit rates, everything I'm looking at in the labor market is back to where it was pre-COVID. And actually, for
Mhm.
the past several meetings, Jay Powell has made the same comment that things have normalized back to where they were pre-COVID. Well, that's nice to know. Things have normalized in the labor and the product market to where they were pre-COVID. Well, where was the funds rate pre-COVID? So I'm not veering from that view. The question is obviously timing. Could be a 2026 story. It could still be a 2025 story, but the path is not going to be perfect. But I know the destination is going to be 1.75. We're going back. We're not going back to zero, but we're going to a 1.75. And the fixed income market is not priced for that, which leaves me with a more bullish view than a bearish view on the treasury market outlook.
That makes sense. And then, so you think interest rates now of 5% on the short end is very restrictive, and then as inflation continues to fall, uh, interest rates get more and more restrictive because the real interest rates goes higher, and that's a theoretical framework that the Federal Reserve goes by. So a 1.75 funds rate may not be as low as it seems if inflation goes lower. I mean,
Correct.
a 1.75 could be looser if there's zero inflation than a 5.5% was when inflation was at 8%.
Correct.
Dave, you earlier you made a comment that was very interesting to me. You said that the economic crisis, the recession of 2008, caused the financial problems. The financial problems didn't cause the economic problems. I'm curious on just your theory of how recessions occur and what causes recession. You referenced 1990 earlier. I associate that with an oil spike. 2001, you associate that with the popping of the equity bubble. And then 2008, you had an oil spike and then an implosion of the banking system. Would you go further and say economic recessions always happen because of the business cycle, and then they cause the bad things, or that the bad things cause the recession? Exogenous variables, for example.
The recession causes the bad things. The recession is what totally undercut the crisis in commercial real estate in the early 90s. It was the recessionary pressures that ultimately undercut um, the capital spending needed to fulfill all the expectations in technology stocks, heading into 2001. I said before, look at the timeline.
Mhm.
Recession started December of '07, Bear Stearns was March of '08, and then the real fun began in September of '08 with Lehman, AIG, and Merrill, and the recession was already 9 months old at that point. So the recessionary pressures, which ultimately impinge on cash flows, and then the cash flows impinge on debt service impairment and spending, which is what GDP is all about. Well, that's what gets the ball rolling. And each one followed a same pattern. We are a credit sensitive economy, inherently interest sensitive economy, and we've never failed to have a recession in the aftermath, and it doesn't happen immediately. It's just that we're all so tempestuous and impatient that if it doesn't happen a year or in the first 2 years, we'll just throw in the towel. But that's not what. I'm an economic historian at heart. But every time the Fed tightened policy and in so doing inverted the yield curve, and this time they kept tightening after they inverted the yield curve, we ultimately had a recession. And there are lags. And the only three times where we really did not have a recession after a significant Fed tightening cycle was in the mid 60s, the mid 80s, and the mid 90s. Mid 90s, of course, is when we started calling Alan Greenspan Maestro. But each one of those three times, the Fed stopped tightening at the point at which the yield curve flattened. It didn't invert. So there's a critical difference. So I don't believe that there's a get out of jail free card, notwithstanding the fact that the lags this time around have been longer than they normally are.
And do you think that there is a true credit bubble in the economy, in the financial system, as there was building up from 2004 and probably earlier through to 2007? I get you think equities are overpriced, and you said there's a price bubble there. And yes, high yield spreads are ultra tight. But is there a true credit bubble where there's just loans that are being made that will never be paid back, and ultimately it will end really badly, and then defaults feed on themselves? Because I'm sure if I was the age I am now in 2006, I wouldn't be able to see it. But I'm not able to see it now. I mean, I know private credit is getting pretty hot, and credit card delinquencies are going up, but I'm just not able to see that excess. Do you see the excess other than in the stock market?
Well, I mean, you've got certain segments of the household sector that there had to have been excesses because you're seeing delinquency rates in credit cards, and credit cards are as big a business as subprime was, back in '06 and '07. If you didn't have a credit bubble in auto loans and in credit cards, then you wouldn't be seeing delinquency rates going to their highest level in 12 years.
Mhm.
No, I don't see a bubble in residential mortgages, but lightning never strikes twice, and it is hard to dis, establish a view that there's a big debt bubble in the corporate sector. However, the one thing that we don't have a handle on is the amount of shadow financial sector debt that's out there. All the debt that's been provided by private credit, as an
Mhm.
example. It's hard to get really great data on that. However, in answer to your question, outside of some select areas that I mentioned, I'm not seeing elements of a massive credit bubble. No. The only bubble I mentioned is the bubble on household balance sheets. The only bubble I mentioned is the extreme concentration of equities at inflated multiples on the balance sheet. The biggest bubble is in the extent to which the household sector never diversified and never rebalanced the portfolio in this bull market. That hasn't happened. So this isn't not necessarily about a credit bubble taking place, and maybe that's one reason why I'm not as negative on credit as I am on the equity market. The equity market has not been supported by earnings fundamentals. If this was about earnings growth only, the S&P would be at 4,600, not on its way to 6,000. That's where it would be. It's been 80% of the move has been multiple expansion. And I'm very nervous about what happens when the movie rewinds. And so, what's driven the stock market? The bubble is not in credit, the bubble is not where it was in previous cycles. Massive bubble in what's otherwise known as passive index investing,
Mhm.
which now accounts for almost 60% of the overall stock market capitalization. And when John Bogle, who was the pioneer at Vanguard in the mid 70s, first unveiled uh, index investing, index funds, he said at the time that he would never expect that this market tranche would be ever more than 20% of the total capitalization of the S&P 500. But now it's boarding with 60. So that's what's happening. It's a bit of a game. It's a bit of a casino. It's a get rich quick theme. That's what the stock market's become. Uh, and so you've got over half the market passive index investing. Think about what that means. When the money comes in, it can't stay in cash. It gets invested in the market with this passive investing. An active investor can move to cash. Active investor actually does homework. Portfolio managers do homework. They look at balance sheets. They look at income statements. They look at valuation. Passive index investing is just throwing a dart against the wall. It's like pin the tail on the donkey. That is how people are investing today, blindly. It used to be a day where you did homework when you buy stocks. Nobody does that anymore. So I see there's lots of dangers lurking. That's where the bubble is. That's where the bubble is. The bubble is in passive index investing. The bubble is on the undue concentration of equity risk on household balance sheets. It's not about debt. It's about what happens to the equity wealth effect on spending when this unwinds. What's the impact on baby boomers? What are we going to be reading about 12 months from now about how people my age or older are lining up to be cashiers at Walmart? So I'm pretty, I'm pretty nervous. I am pretty nervous. This whole market has the Alfred E. Newman photo with that goofy grin saying, "What me worry." That's what this is all about right now, as far as I'm concerned.
And Dave, what is your sense of the severity of an eventual recession? They can be different. The 2001 recession lasted for a long time, but it was seen as somewhat mild. 2008 recession, incredibly intense and horrible, very long lasting. The March or April 2020 was very, very brief, but very, very intense. How is everything, and you're thinking into making the recession call, making about the severity of the recession, as well as what would cause the recession to stop?
Well, what would cause a recession to stop is what always stops. You're going to get the Fed will just cut rates, cut rates. That's why I'm bullish on bonds. The Fed will just continue to cut rates. I don't know the extent to which fiscal policy could play a role because the starting point of the deficit is so stupid high. But you're going to get a lot of government policy support, as you always do. That's not going to change. And in terms of how bad could it be, like I said before, if we get a mean reversion in the savings rate, God forbid, you have to draw some assumptions. You could easily have at least a 3% decline in GDP, which would be a very significant recession.
Mm-hmm. That would be very significant.
That's all it takes is a mean reversion in the savings rate. And what would cause that will be that the stock market finds some semblance of rationality. I mean, I'm just watching this thing every single day. It's like basically, I feel like I'm at a Christie's auction, and people are outbidding each other. $500 million for water lilies. No, and I'm there thinking, why would you? Do you understand what we're talking about when there's a 40 basis point equity risk premium? There's a fundamental problem here that people are willingly, because of course they're passive index investing and they're watching the momentum of the stock market and they can't stand being out of the market, but not understanding that they are paying to take on equity risk instead of being paid to take on equity risk. But you see, we have a mindset today that nobody believes a recession will ever happen again. And we have a mentality that we will never see a bear market again. And I think those are very dangerous propositions. And I think that people will therefore be in for a very big surprise because cycles are cycles. That's why I'm hanging on to my bond position because it's inversely correlated to how risk assets are going to do. And you mentioned credit spread, stupid tight. The valuations, the every ratio was just stupid high, and I don't think that they are sustainable. What makes this call so difficult is the impact that any equity bear market will have on the economy is disproportionate to anything we've seen in the past by virtue of the fact that nobody took profits and
Mm.
allowed the balance sheet of the household sector, which represents 70% of GDP, to become egregiously exposed to what the stock market's going to do. And I'm very worried that we will get a reversal of fortunes in the coming year. That's actually the cornerstone of my forecast.
David, when you say your bear view on stocks, we've been calling it the stock market. I believe most or all of what you're talking about is the U.S. stock market, which you say is in a price bubble. It's my understanding you've actually been somewhat bullish on a handful of emerging markets. So, for example, India, the stock market has been roaring, as well as in your most recent note, Morning with Breakfast with Dave, on Europe. What is your view on the foreign non-U.S. stock markets? India, Europe. You wrote about Brazil, China, and if you're bullish on other emerging markets, how does that square with your call for the U.S. to go into a recession, given that the U.S. is a buyer of all these products from the emerging markets, or often?
I'm just saying to global equity investors, if you have to be fully invested, there's other parts of the world with more compelling valuations. Pretty well throughout Europe, the UK is trading dirt cheap, maybe dirt cheap for a good reason, but they're trading at dirt cheap multiples. So is Germany. And you mentioned some other countries. Look, investing in Brazil, they're going through some fiscal reforms. They just were upgraded by Moody's, but you're getting into some exotic, uh, high risk, potentially low liquidity emerging markets. But there are areas of the world that have compelling valuations. Japan, to me, is still a buy and hold. But actually, the one country you didn't mention that is the most recent relative by recommendation, relative, because you're right, the stock market goes down in the US, it goes down everywhere, it's a matter of degree. But Canada, I just wrote a report saying to my American clients, 70% of my clients are in the States, I say leave New York, come to Toronto, because the TSX trades at a 16 multiple, which is in line with the historical average. The US trades at a 22 multiple, which is 35% above its historical average. The TSX pays you a 3.3% dividend yield. The S&P pays you a 1.5% dividend yield. Canada has a 330 basis point equity risk premium, which means you get paid to take on equity risk in Canada against 45 basis points in the US. I don't remember a time in my 40 years in the business where the case for, as a North American investor, moving cash to the Canadian market over the US market has been as compelling as it is today.
I know there's a lot of gold miners in Canada. As you said, the precious metal has been on a tear alongside silver. Are there any economic reasons that go along with that? Because I think real rates have been rising, which should be bad for gold, and inflation has been falling, which gold is supposed to be thought of as an inflation hedge, and yet the metal is just on an absolute tear.
Mm-hmm.
What is your current view on gold, and how do you explain its remarkable price action?
Given that gold is very strongly inversely correlated to interest rates, and I think interest rates are going to come down. That's a tailwind for gold. I think that the Fed ultimately will play catch down on rates to the rest of the world. The Fed raised rates the most. I think they'll have to cut rates and play catch down to the rest of the world. That should undercut the US dollar. And of course, gold and precious metals in general are priced in US dollars. And then you have this very strong fund flow effect where the world's central banks, and by the way, not just the BRICS any longer, but central banks are starting to rediversify their foreign exchange reserves out of greenbacks and into bullion. So it's really a perfect storm for an ongoing bull market in gold. And it's tough to really forecast a target for something that really doesn't have a cash flow stream. However, it's more situational. Could gold go to $3,000? I've been saying that for a while. We're almost there. Could it go to 4 or 5,000? It probably could, but I'm not concerned so much about a price target. It's just that the bull market will end when these tailwinds begin to subside, and that doesn't look like it's going to happen anytime soon.
Dave, it's been an absolute pleasure speaking with you. Thank you so much for sharing your time and insights. People can find you on Twitter at EconGuyRosie. Dave, just quickly tell us, what is your website and how can people find out more about Rosenberg Research?
Right. Well, you can just go ahead and Google Rosenberg Research, and it'll take you right to the website, or you can type in information at rosenbergresearch.com. It'll take you to the page where you can just get in touch with one of my client service representatives, and they'll get you signed up for a free trial. So you can kick our tires. And then we can discuss what you like and maybe what you don't like. Hopefully you like it all. But just come on the website. Information at rosenbergresearch.com is probably the most direct way to contact us.
Great. A reminder for everyone watching, people can find Monetary Matters not just on YouTube, but on Apple Podcasts, Spotify, and wherever else they get their podcasts. Thank you to everyone for watching, and thanks again, Dave.
Take care, Jack. Thanks for having me on.
Thank you. Just close the door.